Moving the needle on founder failure, one conversation at a time. I'm your host, Justin Gordon, and welcome to Startup 2.0 by Spark XYZ. Join us each week as we give you access to some of the top investors and entrepreneurs in the country to help you think through and overcome the top challenges that startups face.
I think there's no better place in the country to be investing than Los Angeles.
What is the problem that you're solving and for who? Like, what is that specific pain point?
Sometimes when a company is not listening to its customers and just thinks it knows better than its customers, has a really, really hard time finding product market fit.
I want to see somebody that isn't going to stop. You know, this person, you just feel like they're gonna make it work.
Today's guest is Howard Koh, a principal at Morpheus Ventures, which is an early-stage venture capital firm. Howard is primarily focused on sourcing new investments, as well as working directly with portfolio companies. Howard, welcome to the show.
Thank you for having me.
Yeah, happy to have you on here. And with Morpheus Ventures, what I want to start with first is what areas is the firm focused on?
Morpheus is actually vertical agnostic. I think we primarily focus on kind of early stage technology companies. They range from, let's say, quote unquote seed stage to Series A through to Series B. I tell people all the time it's more about maybe more the check size that matters a little bit more, and that dictates kind of what type of rounds they should kind of look at us for. Our typical check size is between like 1 to 10 million. Okay. I would say our sweeter spot in our newest fund is probably anywhere between 3 to 5, 3 to 7 million. Okay. For our check size.
Yeah, and what is kind of the investment thesis of Morpheus Ventures?
I think the biggest thing I think we always look at is scalability. Is this an opportunity or is this a market that is sizable, right? And a lot of times we're looking at kind of companies where, you know, you can reach $250 million plus type exit opportunities. So by definition, the market sizing aspect of things is probably the biggest thing that we look for as either a disqualifier or as certainly I think a hurdle to kind of get across.
Yeah, and with Morpheus too, I mean, what is kind of like the due diligence process that you kind of use at Morpheus Ventures?
I think, you know, one of the biggest things, frankly, I think with all venture funds, the team is the biggest thing that we certainly evaluate against. And you know, as part of that, we try to spend as much time I think with the CEO and the founders, the management, the executive management, as much as we can. Yeah. Obviously, a lot of times these processes are fairly shortened or abbreviated because by nature of kind of time frame wise. But we try to really spend multiple kind of sessions with these guys, really understanding how they think about things, and not just about just trying to get data points for the business, for the company itself. A lot of times it's just getting more familiar, I think, with the founder. So, but obviously, I think we're still looking at market opportunity side, a true addressable market, things of that nature, competitive landscape and whatnot. But I think the biggest thing is really trying to get a better feel, I think, for the founding team.
Yeah, I definitely want to dive deeper into that in a second, but also going back, just so you said different check sizes you have, it ranges a little bit, but jumping between the rounds, going from whether it be seed to Series A or Series A to Series B, like what are the kind of biggest hurdles or challenges between those types of things as well?
Yeah, I think there's definitely different, I think, hurdles, obviously, between the seed and the Series A and between an A and the B. I think probably one of the biggest hurdles between, call it the seed to Series A, is can you really define a good product market fit, right? I think that's kind of one, at least for us, that's kind of one of the biggest things that we look at that differentiate between more of a seed versus a Series A, where a seed, obviously there's, maybe they're still in product development. So it's going to be harder to see, obviously, product market fit. But as you get closer to A, and it depends on, whether it's deep tech or whether it's more kind of enterprise software or technology-driven business services type of thing, along that spectrum, I think there's probably slightly different expectations. But I do think for the most part, you probably have at least an early sense of good product market fit for a Series A. And obviously, I think between A and B is just a matter of, strong KPIs, right? Are you in that growth trajectory, or are you still figuring out go-to-market? Right, type of thing.
Yeah, it makes sense. And then with the diligence process too, I mean, with these different founders you're looking at and you're evaluating, I mean, what are some of those things that make the team themselves, what makes them stand out to you as you look into all these different companies?
I think to some extent, not so much like that one thing stands out. I think, maybe more of what we're looking for, right? I think, first and foremost, I think we look for, founders that are transparent, right? As much as you can, because to some extent it's a trust factor that goes both ways.
Sure.
Right. And we also try to be as transparent as we can, even during our diligence process of kind of where they are in the diligence process, kind of where do they stand, kind of where, and kind of are we, is it a deal that's closable or whatever the case may be. But it also comes to the other side, right, which is for us to be as helpful, and because we take pride in terms of being much more hands-on with our portfolio companies. Most of us have operating backgrounds. We take more of an operator's perspective in really working with the companies kind of post-investment, right? And because that's part of kind of what we try to provide to risk mitigate the company side, and as well as for us, we want to know when there's problems. Right. We don't want to have the founders or management obfuscate problems. We want to be helpful in solving those problems. Right. Yeah. We're not there to kind of bludgeon them over the head when there's a hiccup kind of in their path, in their journey. We want to be as helpful as we can, and we can't be helpful, I think, if the company is not as transparent. So I think that's one thing. But I think the other thing is, depending upon kind of what this company needs moving forward, right? And whether or not certain companies are more capital intensive than others, for example.
Yeah.
And that sometimes takes a certain type of founder, right, that can raise successive funds, right? And you can argue that one of the biggest reasons for Uber's success early on was the fact that Travis was just an awesome kind of fundraiser, right? He literally out capitaled like almost of his competition, especially at those earlier stages. So whether that's a required skill set or not, I think it's a matter of matching the skill set to what the company needs moving forward. Whether that's a sales guy who really knows how to penetrate Fortune 100 customers, or it's a capital game where there's not as big of a differentiator per se. It's just who has more firepower. Right. And I think it's really matching those, skill sets is much more important.
Yeah, and kind of in that similar vein, just looking at it a different way as well. I mean, are there certain things that are an automatic no for you, or like almost certainly like no? Because I imagine you're looking at hundreds and thousands of companies. Like, are there certain things that are kind of like, okay, no, move on, next? Like, I'm just curious if there's anything like that as well, or it's more so just like the fit with.
Well, obviously, we see a lot of companies in terms of, a very cursory level where, let's say, we don't really even let's say have a phone call with the company or have a call with the company. There's just so many variety of things that kind of could knock them out at that stage. It's almost, I think, too varied, too diverse. But I would say at least the ones that kind of get to a point where we actually have a conversation with them, type of thing. I think a lot of it is just do they really understand their market? Do they really understand their product? Do they really understand this better than anybody else, right? We, as venture capitalists, to some extent, we're somewhat jack of all trades to some degree. We're looking at such a variety of type of opportunities. And so we really rely, and we're really investing in those guys and those founders, that they just know much more about that space, that industry, more than anybody else, obviously including us. Yeah. Right. And I think that's, the biggest kind of disqualifier. If we ask two questions down and they should know, right? All of a sudden, that it just, you can see the depth of knowledge is not there or lacking, I think is one aspect. And I think two is, pardon the pun, don't bullshit a bullshitter. Right? There's a lot of guys who, you ask a question, he flat out doesn't really know, but still gives a pretty, BS type of answer, right? And you sort of know it, right? And be it because we just happen to know, I think it's some additional data points, or frankly, a simple Google search would have, like, in 30 seconds, would have disqualified that person's response, right? I think that's another kind of just easy, like kind of not an easy disqualifier, but certainly one of those things where it's hard to recover from, right? Yeah. I'd rather have somebody who says, like, I don't know, but I'll get back to you. I'll look into it and get back to you, right? Yeah. But that's okay. You're not going to know everything, right? But back to the whole point of being transparent and whatnot, if he's kind of BSing me on this now,
What's next?
right? What's next, right? How much work do I have to figure out all the time to kind of peel the onion a little bit, right? And frankly, I think we just don't have the time kind of for that. And sometimes that time is so critical, important for especially early stage companies.
Yeah, and with this process too, I mean, how long does this process take? Obviously, it's not like a set thing of how long it takes, but for founders, watching and like wanting some context, like how long does your kind of due diligence process even take?
I think it just depends. I think it's going to depend on, I think, the industry, right? If it's something that is more, let's say, greenfield versus something that is kind of more of a legacy business that you're trying to call it disrupt or transform, utilizing technology to be more efficient or whatnot. So I think there's a little bit different, I think, data points that you're able to gather quickly, type of thing. And for the most part, look, I at least for us, we try to at least get to whether or not we believe there's something there that we want to kind of get there within like 3 to 4 weeks, type of thing. And we'll try to indicate that to the companies, right? That, hey, we're sort of getting there. We may or not be there yet, type of thing, but we're in the right trajectory. We really think there's something there. We're going to try to kind of, at least propose something. I think in the nearer term, or we'd say, look, this may not be a good fit. And frankly, I think we're also trying to triage sometimes. We're all kind of, time is the one thing that we can't scale.
Yep.
At least from our side. So we try to, as expediently as possible, kind of go through the ones that make sense. Obviously, there's a lot of companies that still fall through the cracks because just everybody's inboxes are just like insane, right? And so we try to do our best we can. But I think for the ones that I think we're really on, we try to be in regular communication with them so they can really figure out in 3 to 4 weeks kind of where they stand. Look, having been the entrepreneur myself on the other side, I can appreciate kind of being on the limbo, right, on the other side. I sometimes a quicker no is actually a better than even a much longer yes, frankly, sometimes. Because that could be 3 months down the road, 4 months down the road, but you have something else that you could be more of a bird in hand. So I never, dissuade, I think, entrepreneurs from saying, hey, always wait to hold out for me per se. Like, look, if it's a bird in hand, it's a bird in hand. And you can make that decision, but I'm not going to kind of, pressure you to do one or the other. You're going to do what's best for kind of you guys.
Yeah. And with Morpheus Ventures too, I mean, what is it about them that makes like you guys stand out or different from other ones? Because there's so many venture capital firms now and different accelerators, incubators, others. Like, what is it about Morpheus Ventures that is a value add or makes you stand out for companies?
Yeah, I would say that I think to kind of a point that kind of we touched on a little earlier, which is, almost all of us have either started a company or run a company before. Yeah. Right. And most of us on the senior investment team side, we've all done that. Yeah. Right. And so we tend to view from a much more, like I said before, on an operator's perspective, we roll up our sleeves. I think probably a little bit more so. We get into the weeds of, cell structure commission type plans. Right. We go down to go-to-market strategies. We interview kind of alongside the CEOs for executive management positions, especially early on when the team's not complete. So we and some of the other points are like kind of how do you price enterprise software, right? Value extraction is a very challenging thing, right? For enterprise software companies, right? Do you have tangible ROI? Going through that process of it's sometimes more art than science per se, and you're trying to get as much data points, as much experience as possible in trying to figuring that out. So I think that may be a little bit, I think, more, not say unique per se, but certainly I think, a lot of the other firms may not take that perspective. Yeah. And maybe not as much the hands-on kind of aspect, I think, with the companies that we do. And that's probably maybe born out of the fact that we typically end up leading or co-leading around. So, most of the time we're on the board of directors, so we take that pretty seriously. We take that pretty much to heart. And selfishly, it's to also risk mitigate.
Yeah.
Right. Kind of our investment.
Right.
So we tend to kind of work with companies and invest in companies where we can be kind of more helpful than just simply the capital side.
Yeah. And how many companies roughly are you investing in a year?
I think what we're looking to do, I think going forward out of a newest fund is probably closer to, call it anywhere between 6 to 10 investments, somewhere around that range per year. So we take I think a little bit more of a concentrated portfolio kind of approach.
Yep.
We don't write too many like $200,000, $250,000, $500,000 checks type of thing. I think when we're committed to companies, we're committed to the companies. That's why we spend so much time.
Yeah. You can do that at that point.
We can actually have the time to actually do that,
Yeah.
right? Versus you have a portfolio, you do 20 investments a year, and how do you allocate the time to really be able to kind of spend with them to kind of help them kind of get to that next milestone. So that's something that we're very cognizant of. And so every time we look at an investment, we look at it as that means that's one less investments that we can make during that period of time. Obviously, there's going to be kind of natural selection, churn and whatnot in portfolios throughout the life of the fund.
Right.
But that's why, I think in any year, right, we're very cognizant of the fact that we are resource limited.
Yes.
Right.
Only do so much. Yeah.
But from a human capital perspective.
Exactly. And then with that too, you having operating experience and entrepreneurial experience like on your actual team, then what are some of those challenges that you typically see with working with these startups in your portfolios?
A lot of times I think the CEOs and the founders just don't realize how much of a time suck that HR really is, right? I caution them or warn them a lot, I think, during our process, especially during our closing process, even before it, that don't be surprised if 40% or if not majority of your time is spent building your team, right? And I think especially for the ones who are so used to being also the BD guy, the lead sales guy for their product, the lead visionary kind of for their product, they lead everything for their product, that they now have to rely on the team that that's there and that they're recruiting to do a lot of that alongside of him, and they have to be able to just be able to step back.
Yeah.
Right. Be able to let go. Right. And I think that is a challenge that a lot of especially founder CEOs, I think have to come to kind of an understanding of and say, okay, that I'm willing to do that, or else it's so hard to scale a company, right? How do you go from a company who's 7 people to a company that's 50 people doing, 20, 30, 40, $50 million plus in kind of revenue? It's just remarkably difficult to do, right? Without that next layer type of management. And I think that's the biggest challenge, I think, that I see when I work with kind of my companies, that the founder CEOs really have a tough time doing.
Well, knowing that too, I mean, what are those conversations like with you and these founder CEOs? Like, to try to make them understand that exact point? Like, what are those conversations like? What are you trying to tell them? I'm curious about that too.
I think it's very iterative, right? They're not gonna all of a sudden go, yes,
of course,
I get that, of course that. A lot of them still want to micromanage, right? They want to kind of be involved in everything. It's their baby, right?
Right.
They bootstrapped it to blood, sweat, and tears, right? And so it does take some time, and I think the ones that can get out of that shell, I think a bit more. It does help the company overall, because to some extent your runway is limited, right? The amount of capital you raise is limited. And to some extent also during the hiring process for the executives, right? I think that's a good time to continue that conversation with them, right? And I think it gives also them more confidence because we're leveling up in terms of the personnel kind of at the company, right? That they can say, okay, I do believe that person can probably do that even better, right? Or they're really well suited for it. I'm comfortable relinquishing and letting go in that area, right? And that's important. I think as they start seeing the leveling up kind of their team, right? It gives them a little bit more confidence, right? To be able to say, okay, I'll let go a little bit here. It seems like and especially if it's a collaborative process, it's not us saying, hey, we should hire this guy, right? We generally try to serve, at least I try to generally serve as just simply a perspective, a data point kind of for them. We're there to be helpful.
Yeah.
We're not there to operate. We're not there to micromanage. We're not there to take over the company, right? We invested in them for a reason. We invested in the founder, him or her, as the reason why we wrote that check.
Yeah.
Right. And so it is an iterative process. We try to kind of obviously shorten that process as much as you can. Sometimes people get it really quick, and sometimes it does take some time.
Yeah. And then knowing that, like, obviously in your portfolio, every company is not going to be a home run. They're not going to just crush it. The companies that are either don't hit the KPIs or just not where you want them to be. Like, how do you have that conversation about, it's going to fail, it's not where they need to shut it down. Like, how do you help them through that, or help them decide, like, okay, this probably is not going to continue? Like, how do you have that conversation too?
Well, I think the realization of that is usually a progression over time. It's not all of a sudden,
right, one day,
oh my God, wake up one day, this is not working.
Sure.
Right. It's usually, it's been 3 months, it's been 6 months, right, of a grind, or just nothing's really happening, right for the company. And I think you do want to have those conversations, I think, during that process. Hey, look, and you try, like, we're there to, try to make it a success, right?
Yeah.
We're going to see if there's other avenues to be able to kind of get there, right? And so I think it's an iterative conversation they have. And I think a lot of times it's more, you both come to a realization that, this may not be the best use of their time, right? And because these companies, I mean, that's their sole investments. We have other kind of portfolio kind of companies that it kind of that we've invested in, right? We spread our investments across the board, right? Whereas for the founders, this is it, right? And they're making a bet with their own blood, sweat, and tears, right?
Yeah.
And to some extent, if it's not working for them, they have actually much more to lose than anybody else. And a lot of this, I think, conversations gets accelerated by simply cash on hand, right? If you're burning money, right? It's another thing when it's effectively, you're just getting by, right? There are sometimes we call them the Walking Dead to some extent, the zombie companies, right? Where they're just getting by. They don't really need. It's hard for them to raise capital, but they're also not going to run out of money, so they can kind of just do what they're currently doing. Yeah. Right. I think those are actually sometimes a little bit more challenging than the ones that, we gave it our best shot. Right. It didn't happen. That's what happens in early stage kind of startups. Let's move on. Right. And I think sometimes the simple capital on hand, I think, puts a finer point, I think, to those conversations, right? Both from a timing perspective,
of course,
obviously, but also from a practical matter perspective. It does actually kind of help maybe that conversation along sometimes. It's like, believe it or not,
you have left.
Right? Exactly. I think there's a pragmatic kind of aspect to it.
Yeah, and then giving you a chance to kind of shout out some of those more successful companies at Morpheus. I mean, what are some of those one or two companies that are really crushing it at Morpheus Ventures, and like, why do you think they are? Yeah,
I think, if you look across our portfolio, I think, it's fairly diverse in terms of kind of the areas that kind of we invested in, right? I think one of the more maybe one of the more interesting ones is like Starship.
I knew you were going to
say that. It's they just at least it's more interesting. They just, for example, I think just yesterday or the day before, they just launched at a new university campus at Ole Miss, right, for robotic delivery, right? And we really think that, the autonomous delivery aspect of it is really going to change that. Maybe it's not even the last mile, but the last quarter mile, right, of logistics, right, of fulfillment, right, and get to a point where the unit economics actually makes sense, right, where a user is no longer, a consumer is no longer kind of trying to think between, well, is it worth it to me to get it because the price point will be, well, why not?
Yeah.
Right. Versus a cost benefit kind of analysis per se. Yeah. And I think we're starting to kind of sort of get there. And I think, for better or for worse, Amazon has certainly kind of accelerated that process for
Yeah.
consumer expectations of fulfillment,
Yeah.
and on-demand fulfillment almost. So I think that's certainly kind of one. And the funny thing is, I think I would say one of our kind of, I don't know how much of a sneaky success story it is anymore, safety culture, right? They started as basically just a checklist application, right? But they've grown so rapidly. I think at one point they were literally growing 10% month over month in terms of just growth, revenue growth, I think kind of user growth and whatnot.
Yeah.
We were pretty early stage and we did the Series A. Index ended up doing the Series B, and then Tiger, I believe, did this effectively the Series C.
Okay.
So they've been just on an unbelievable ramp. And if you simply look at it from a sexy tech point of view, you certainly wouldn't put them in that category.
Yeah.
But from a business execution perspective, I'd say that there's probably not too many companies that have that type of trajectory.
Yeah.
And performance trajectory, just business. It's not just about hey, users. But from a business metric standpoint, paying user standpoint, it's pretty astonishing, like, kind of what they were able to do.
Yeah, I mean, some of those companies, like I said, they're not the sexiest companies per se, but then you look at the numbers and what they're doing, it's like, oh my goodness, this is amazing.
Correct. Like I said, I think tech for the sake of tech is really, for me, it's not that interesting. I think it's fundamentally kind of what you can actually do with it,
Right,
and what you can execute kind of with it.
Yeah.
And that, I think that's pretty true. I think even across our portfolio, type of thing.
Yeah.
So even Starship is like, it looks sexy. We still go back to, does unit economics work?
Yeah, doesn't make sense.
Right.
And I looked at the portfolio and I was like, that one stood out right away. Starship.
Oh yeah, it's just
You're
it's fun.
like,
At the very minimum, it's fun. It's exciting. It's fun.
Yeah, that's
type of thing.
awesome. And now we'll take a quick break and hear from our sponsor, Brex. A big heartfelt thank you to Brex, who without their support, this show would not be possible. We've seen firsthand the difficulties accessing basic corporate credit without providing a security deposit or personal guarantee early on. As companies grow, managing expenses has become more difficult and time-consuming, which is why we've partnered with Brex to offer a corporate credit card that is not personally guaranteed, offers higher credit limits, provides auto reconciliation, and integrates with ERPs using receipt capture. Brex is the credit card of the startup ecosystem, and we highly encourage you to check them out. And back to the show. So what industries or what areas of kind of the startup landscape are you most excited about right now, Howard?
Look, because we're vertically agnostic, we don't have any kind of specific areas where we must make an investment, right? I think there's certain thematics. I think we're looking anything much more into that we actually just see more discussions around internally, as well as just the companies that we're really delving more into.
Yeah.
If that makes sense. I think logistics from a thematic area is an area that we're spending a lot more time in. And we look at the way I look at logistics, I think, is more not just simply from a transportation kind of perspective, is really from, let's say, post manufacturing out the door to the consumer or the enterprise literally getting it.
Yeah.
Right. From that perspective. Right. And that could be from ocean freight to port management software to warehouse management software or robotics and pick and pack fulfillment. Right. All the way to FTL, LTL with, guys like Convoys of the world, Next Truckings of the world and whatnot. But literally is like literally everything in between. Right.
Yeah.
And so that's, it's certainly an area that I think that we're spending quite a bit of time. And I think the other side is like things like digital health. Right. We don't invest in biopharmaceuticals or anything like that. We don't have enough PhDs on our staff to make it a smart,
informed decision.
Informed decision. Yeah, there we go. I think that's a much better way to put it. An informed decision point of view. I think it's really more how the big data side, the data side of things can either affect outcome, like the care outcome, and/or processes. Right, call it administration processes, payment processes, and whatnot. And if you look at our portfolio, I mean, we touch upon that in a few different ways. Sidecar Health is doing it. from a healthcare insurance perspective, it's just a new mechanism in which kind of care can be provided, type of thing, where it doesn't change kind of the who provides the care, or anything like that, but it does change how a consumer should seek care, and at a lower cost point, right? And it's much more to deal with the administration aspect of it, a lot of times, more so than simply, oh my goodness, I'm going to change, I have a cure to cancer, type of thing. So I think there's that piece, and I think Bestow is more on the life insurance side. It's more tertiarily kind of involved in that, but we're also in a clinical logistics automation company in Orange County that is trying to, I think, provide a much more efficient use of fixed assets at hospitals, like their OR operating rooms, right, or their emergency kind of departments. It's really about cycle time. How many cycles can you get out of a fixed asset? Because it's if you lose it today, it's not coming back to you. Right. It just is. And so that type of things that we spend quite a bit of time on. And I think going forward, I think we'll probably spend a little bit more time into how 5G and low Earth orbit can impact services, software side. Less so maybe on the infrastructure side per se, but the impact of kind of that infrastructure is being available now. Right. How does that impact the different type of services that can be provided on top of, be it a software layer, or just a services that layers on top the infrastructure itself.
Yeah, it makes sense, especially as Elon and Jeff are sending satellites up
so
nonstop. We'll see how that changes things. And with the actual venture landscape itself, how have you seen that kind of evolve in the last few years, and where do you see that evolving as well?
Well, I think you're seeing a lot of, quote unquote, later stage venture firms now going earlier and earlier and earlier. And part of it is probably stemming from there's quite a bit of capital chasing. There's always limited sets of I think really good deals, I would say, and that's always been the case, whether a good, bad, or ugly market.
Sure.
Right. But to a lot of these later stage venture guys are going in early, it's just reserve them a spot, right, to be there when a larger financing happens. Right. And so you're seeing a little bit more of that, right, being kind of in effect much more so than maybe even before, where guys who would traditionally do B's and C's would reach down to A's, maybe even to a seed, right, writing a $250,000 check just to be on the cap so that they get the call when they're going for a larger financing, right, and that's it, just to have a seat at the table, right. So we're definitely seeing kind of that. And I think the other thing is, I think there's a bit of a barbell. There are companies who get term sheets, get multiple term sheets, right, competing offers, right, and they're starting to get quite a bit just get zero traction, right. So everybody's chasing a certain group, right, and obviously there's guys in between, but you really start seeing the haves and the have-nots sometimes. I think much more so, and that's good, bad, or ugly. That's kind of part and parcel, kind of the environment that we're in now, type of thing. Yeah,
and with that too, with obviously them bigger funds and going down to seed, even Series A seed. With companies that they either have some traction, or they have a good idea that's actually people want to invest in. How do they evaluate those different opportunities and then choosing an actual fund to just, give them money? If they have options, what questions should they ask? How should they decide that then?
I'd say in choosing an investment partner is like a marriage, right? I would say that you end up spending more time sometimes with them than even with your family. They may end up spending more time with you, right? During that duration, right? And think of it as who can really be helping you move forward and really get to that next milestone. So I'd say it's more a person. Can you work with them? Sometimes life is just too short. Right. And do you think you can have a really good not just the fact that he's a nice guy. Right. Nice guys doesn't sometimes move the needle for you. Right. But can you work with him? And do you think that he or she can be helpful for you in getting that to that next milestone? Right. And what can they be helpful with once you get there? Right. And I think that's the lens that I would always look at it. And look, obviously, valuation, economic parameters are always, I think, part and parcel. But I think if there's an opportunity, to have that choice, right? I would look at it from same as when we invest in companies is as much the people. I would say that I think on the flip side, it's also true. Even from the investor side, the best deals aren't always the best companies.
What do you mean by that?
You could be cheap, right? It could be like, oh, hey, I got 20% for $2 million,
it's just
right?
Okay.
Or versus, well, that one's going to cost me $7 million to get 15%. Doesn't mean that the guy you pay $2 million to get 20% is a better investment, right? Than paying $7 million for 15%, right? You may think like, well, the valuation is so different, that's just more bang for buck, but that's not necessarily true. I think I think the reverse side is, I think, very, very much also true. Is if you get the right partner on the other side, right, that can create much more value. Because at the end of the day, these are all paper gain, or paper valuations.
Yeah.
What matters at the end of the day is kind of when you exit, right? And really, given that's the end goal, if you work backwards from there, it's really more about who can help you kind of get there, right? That should matter more, right? I think to you, and it's really not about a 10, 15, even 20% difference sometimes, right? In the whole realm of things. Even on the flip side, it's also true for us, kind of as well, right? It's does that make sense, right? I think that's the number one thing. If I was going to caution an entrepreneur, if you have options, always go with the guy who you think he can help you kind of get there. And a lot of times, like somebody you can work with. So if the guy's a complete asshole, even though he's brilliant, but if you can't work with him, you can't get that value out of him. That still doesn't help you, right? He could be brilliant, but there's a disconnect, right? You want it to be, I think, a something that can be productive. Right? Look, acrimonious sometimes not acrimonious, but you don't always have to agree. You actually don't want to always agree. You shouldn't always perfectly agree. You want that different perspective that challenges you, right? But I do think it's something like, well, he may not always be the friendliest guy to me, but man, when we really get into these discussions, it could be heated, but some stuff really good comes out of it. That can really move the needle for me. That's actually, I think, even more important.
Yeah. Are there particular questions that you think that entrepreneurs or founders should be asking the VCs or anything I get at vetting them for that? Like, are there things that you have entrepreneurs ask you? You're like, oh, okay, like that's actually a good thing. Good to know, like that they should be asking to help them in that process of choosing then the VC.
I would always ask them, like, who am I going to be really working with, like, on a post-investment basis, right? Like, who's the guy, right? And if it's your lead investor, obviously, who's going to be sitting on your board, right? I think sometimes people forget to ask. It's not that they forget to ask, but it's not a critical point.
There's a lot of questions,
right? There's a lot more questions beyond that. There's like, I got the investment. That was obviously checkbox 1, 2, and 3,
get the money,
type of thing. But I do think and sometimes kind of the guys they spoke to, kind of doing the process, may or may not be the guy that actually works with them, kind of afterwards. So I think that's actually critically important to actually know. Investment sometimes the easy part, right? It's really now post-investment. What can you guys build together? I think that's always, to me, always more challenging. It's exciting, but it's also a challenging part of it. So I think ask the question of who am I going to be working with, and frankly, even if it's not your lead, right? Find the guy who you just put on your cap table, right? The reason why you took them as part of the syndicate, if you had a choice, right? If you can build out your syndicate the way you would like, well, there's a reason why you wanted them versus somebody else, right? Well, is that guy going to be the guy that I'm going to be able to communicate with, and how available, right? Because your board member is pretty much, beholden to be, fiduciary beholden to be available to you to some degree. But there are guys who go above and kind of beyond. But for the guys who aren't, are they going to be really value add as much as you thought initially? So how available are they to you, right? And have that conversation and understand how they work with other companies,
Yeah.
right? That they've had in their portfolio. I think some people sometimes don't ask that question. They're just so excited about just trying to kind of get to a term sheet and get to a closed deal. And I get that, right? But those are questions that I think entrepreneurs should ask.
Yeah. And with it, you mentioned being more hands-on at Morpheus Ventures. Then, I mean, how is your time kind of spent? Your personal time? How are you personally spending your time, like day to day, and like in your role at Morpheus?
I think as you start adding more portfolio companies, I think that time split always sometimes gets more challenged, right? And between kind of the board directorships that you have, right? That the companies that you're responsible for. It also depends on timing. If the company is fundraising mode, kind of time, it takes more time.
Yeah.
Right. And just depending on the juncture, it's kind of more of a stop and start type thing. So I do end up spending quite a bit of time, I think, with our current portfolio companies, especially the ones I sit on the board of. And then obviously we're still looking for new companies, right? And so it's a hard balance to be had sometimes. I think, sometimes it could be 70-30 portfolio new, could be, and other times it could be exactly flipped. It could be 70-30, just depending on kind of if the companies have hit their stride to some degree.
Yeah.
That they don't need as much hand-holding. We're just more, sounding boards for things.
Yeah.
Right. And that a lot of times we can be more efficient with time kind of management there. So, for us, I think it's always a balance, especially for those of us who, have, kind of board directorships type of thing.
Yeah.
It is a bit more of a balance act.
Managing that time. And then with Morpheus Ventures, how did you end up at Morpheus Ventures?
That's a good question. I was born. No, I'm just kidding.
Blue pill or red pill?
Yeah, there we go. So the team at Morpheus, I think maybe one of the interesting or maybe the more beneficial things about the team at Morpheus is that we've been together for quite a bit of time. I think almost a decade now.
Yeah.
Now we didn't start as Morpheus. We've kind of evolved into kind of institutional fund management, whatnot. And Morpheus is our latest fund family, kind of for it. So we've been together in the team kind of for quite some time before. So when I first joined the team, I think we were much more of call it a merchant banking shop. We were still doing much more principal investing type of thing. And I kind of more looked after that piece. But then I think as we kind of got into more institutional fund management kind of side of things, I started spending much more time on the institutional side. I was at a venture capital firm kind of before it, so it was kind of part and parcel of the experience kind of factor. So it kind of naturally morphed into I spend now all of my time on the institutional kind of fund side of things, and now we're in our second fund now type of thing. So at least out of the Morpheus fund, Morpheus fund family.
Yeah, and we mentioned being entrepreneurial background, operational background. Like, can you speak to how that kind of played a part into like what you're doing now?
Oh yeah, look, it's funny. I did venture before. I did one stint in venture before my entrepreneurship kind of journey, right? And I would say my perspective as a venture capitalist is very different the second time around in venture capital. I think the lens that you get to have as an operator, right? Building a team, getting your first sale, right? Developing vendor relationships, all that stuff. That I think gives you, a different perspective. At the very minute, it gives you empathy, right? To what an entrepreneur kind of goes through. And I'd say that, this operator lens, I think, at least for me, I think it makes me a better partner for the founders and entrepreneurs, especially when I sit on their boards. I understand at the very minimum, or kind of what they go through, and can kind of work with them kind of through those challenges, and hopefully see around the corners that they haven't seen yet.
Right.
That I know is coming. Because I've seen it before firsthand, from an entrepreneur's perspective, as well as also kind of other portfolio companies' perspectives. But I think it has definitely, changed the purview and the perspectives.
Yeah,
kind of
and
group it.
having that perspective though too, like being an entrepreneur versus VC. I mean, is there one that would you ever go back to being an entrepreneur?
I don't know. Like I'd say they excite me in both in different ways.
Yeah.
Right. Look, I'm an electrical engineer. Right. I'm an engineer by training. I like building stuff.
Yeah.
Right. I have an innate curiosity for technology and all that stuff. I think in a operating role, in a company role, you can be much more focused, right, on doing this one thing.
Yeah.
Right. And I think there's value there. It's fun doing that. So you don't have to kind of go to 6 different, kind of different paths at the same time type of thing. And that's exciting. You could build it and mean something meaningful. I think whereas as a venture capitalist, because we take on more of a lead role sometimes in investments, we get to really build alongside the companies. And the nice part is you get to build, multiple, kind of multiple companies together,
right,
with them. And so, you may not have the focus on one, but you really also get a broader perspective across the landscape. And that to me, the innate curiosity to me, like I'm always like to learn new things. And that's actually, it's actually fun, right? Because, I sit on board of a construction robotics company, and I sit on board of a clinical logistics automation company for hospitals, right? On the other side.
Yeah.
Right. Those two, for example, are very different, kind of companies.
Yeah.
Right. But they're just as intriguing to me in different ways. Right. And so I don't know. I don't know if I'll go back to an operator role. I guess it just depends. I think, life, I think if you talk to most venture capitalists, there's no one reason or one path that people get into venture capital, right?
Yeah.
It's not like investment banking
right.
where it's like, it's very kind of structured and whatnot. It tends to be more of a meandering path that gets there.
Yeah.
Right. And so, and a lot of times it's more serendipitous than a planned path per se. And so, you never know what life kind of throws at you. But I think for now, I certainly love kind of what I do now on a day-to-day basis.
Yeah. And with that experience, so with your, on the both sides of that, venture capital experience, also entrepreneur experience, is there anything else you'd mention to founders, anything else you think they should know that maybe we haven't covered yet, or anything else you could think of for them?
One thing I always, encourage entrepreneurs is you can't stop moving forward. And a lot of entrepreneurs would tell me, well, I need that capital to kind of get to that milestone. I need that capital to just move forward. And I would caution them saying, well, if you're not getting any traction today, right? And if all you're going to be doing is pitching for the next 6 months, the same story, then what's going to change in the investors' minds, right, about the company, right? The best, I'll give you one good example.
Yeah.
Literally, we have a term sheet we just executed yesterday, right? And we had passed on the company probably about a year ago, right? Because we thought they weren't there yet.
Yeah.
Right. And the company progressed, right? They actually executed on some of the things that we were concerned about, right? And now, fast forward 1 year from then, right? We re-engage with them. Hey, you guys did exactly what you said you were able to do, and address a lot of the concerns that we had.
Right.
And we literally, they signed, we signed the term sheet yesterday.
Yeah.
Kind of with them, right?
Wow.
And so I think it's that progression. And I know for a fact that if they simply pitched the same exact thing to me, right, from a year ago, it wouldn't have resonated at all.
Right.
Right. Like it would be, you might as well not start the conversation, right? But because they had progressed, there was additional data points. We're like, oh, well, okay.
We see.
That just mitigated what we were concerned about, right? But you wouldn't have that if you didn't try to move forward. And I get it, sometimes you need the capital to some degree.
Yeah.
But see if there's other ways of progressing. Yeah. Right. Maybe it's a strategic partnership that really gets you over the hump, that addresses a go-to-market concern, right? It's a development. You need capital for development. Could you strike a deal because you were able to sell your vision to a guy, a team that they bought in and then you gave them either options or stock, but that you were so effective in convincing them that they took very little capital up front to kind of do it. That not only goes to kind of movement forward, but it goes to also your ability as a leader, as a visionary founder to kind of move the process forward, type of thing. And that's a type of also the entrepreneur that you want to back, right?
Yeah.
That can overcome. Look, startups are hard, right? There's nothing easy about a startup. There's going to be a lot of things that you have to overcome. It's those, I think, entrepreneurs that have the perseverance to figure out a path, if that makes sense, to get there. I think those are the type of, entrepreneurs, to your point, even previously when we talked about what we were looking for to some extent, that's what we were looking for, right? As investors, you want that guy who couldn't take no for an answer, right? Who figured out a way to kind of get there, right? Because there are going to be bumps in the road. There are always going to be pivot points. There's going to be hard decisions to make, right? Nobody's ever a straight line up and to the right, right? That rarely ever happens. So you want that guy to be at the helm, right? And that goes to another checkbox that you have on management team that we talk so much about.
Yeah. And how can people go connect with you and learn more about Morpheus Ventures?
Yeah. So obviously you can. I'm generally fairly reachable via email, and I try to be as available as possible at a lot of the local events. We try to be out there. I mean, we're not trying to hide from anybody. And that's the funny thing is people always say like they're hard to reach or hard to approach. The funny thing is venture capitalists want to connect with entrepreneurs. We try to make ourselves as accessible as possible, but we also hope and expect that the entrepreneurs will do the same, right? They are going to be creative about kind of reaching out to us, right? Trying to make the effort, finding kind of a touch point with us, meeting us at an event, and we try to kind of be there as much as we can. Obviously, that's on our side, but at least be there so that you are kind of able to reach us. And a lot of times it's through kind of service providers. A lot of times it's the lawyers, it's your accountants and whatnot that we have relationships with.
Right.
A lot of times it's a referral. I think a good referral goes a long way. I'd say 90% of our deals are all referral deals by kind of people within our network in one capacity or another. It's a very relationship type business, but we're also there. Like there's a couple of deals like Sidecar, for example. We actually reached out to them, right? I reached out to Patrick at Sidecar. We sort of just misconnecting at Montgomery Summit, for example, right? But it was a company I really wanted to talk to, so I reached out to them separately. But because they were at least there, right? I found them, right? They made, I think, the conscious effort of being out there,
right?
That we were able to connect, right? And I think things like that, referral is probably the easiest way. I'm always reachable by email, but referral is always the best way because a lot of times they also are doing a little bit of vetting for us to see if it's a good fit. A lot of times it's not that, we don't want to invest in certain things. It's just, it may not be a good fit kind of for us.
Yeah.
And a lot of times the referrer actually knows they are a good fit. So it doesn't waste their time, the entrepreneur's time as well, because it's precious. Time doesn't scale.
Yeah.
Right. And if they're talking to 100 different investors, a lot of times half of them, they shouldn't have talked to. They weren't either ready for it or it wasn't a good fit. And it was just a waste of their time that they could have focused on either building the company and or talking more, I think, intimately or more in depth with the ones that would be better fits.
Yeah, and it comes down to entrepreneurs too doing their homework to figure that out, right?
Yeah.
I mean, then from there, it's like, then spend your time where it matters most.
Yeah, and figure out how to get there, right? And in LA, literally, you could be at an event every night.
Yeah.
right?
There's so many.
at some networking event where there's an investor, service right, somebody. It's now a fairly well networked town from a capital kind of perspective.
Yeah.
Right. And there's a lot of guys who are well experienced with it. And if you refine your pitch, really understand kind of your value prop and be able to kind of coherently kind of get that across in a very short, like when people say elevator pitch, it is very much that. Can you really understand your product enough that you can tell somebody in very short period of time, like, oh, that's really interesting. You should actually connect with some like so and so, right? And that happens, I think, more so than not, right? A lot of people are always trying to connect the dots, right? And they're happy to be helpful. Yeah. So that's the one nice thing about I think LA.
True. There's a lot of that. Howard, thank you so much for taking the time to come on the show today.
No, I appreciate you guys having me.
Awesome. Thanks for checking out Startup 2.0 from Spark XYZ. If you want to learn more about startups and investing, you can check us out and join the ecosystem at sparkxyz.io.